You call in the Treasury, the notes from the Treasury that are it's 42.22. You remark the gold to $10,000 an ounce. You just mark it to the market price. You would get back, when you send that back to the Treasury then could send you over $1 trillion that they just create from thin air. It's an accounting gimmick. But you get $1 trillion that you wouldn't have to go sell bonds for. Well, what if you did it at $9,000, $10,000? You get two some odd trillion dollars. Gold that we already have on the balance sheet is some arcane price from 50, 60 years ago. We're just going to market at today's price. And by doing so, the Fed is going to hand the Treasury and we're going to put into our sovereign wealth fund $1 trillion. Okay. Anyway, they've said, watch the video from February the 2nd. They've said this is how they're going to do it. Monetize the asset side of the balance sheet. So anyway, I make a big deal of that in this year's macrocast. And it might sound crazy.
A growing macro thesis now centers on gold revaluation as a deliberate policy tool rather than a market accident. Instead of issuing massive new debt, governments can reprice the gold already sitting on their balance sheets. Marking gold closer to its actual market value, rather than outdated prices from decades ago, instantly creates trillions in new financial capacity. This isn't stimulus in the traditional sense, it's balance sheet engineering, achieved through accounting rather than bond issuance. Hemke outlines how a revaluation of gold to the $9,000 to $10,000 range could generate $1 to $2 trillion for the Treasury without selling a single bond. The mechanism is straightforward. Monetize the asset side of the balance sheet instead of expanding liabilities. As debt markets strain and confidence in fiat weakens, gold revaluation becomes a quiet but powerful release valve. It reframes gold as a monetary reset tool, one capable of recapitalizing the system while preserving the illusion of stability. Now, we present the clips from Hemke's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
50,000 people that live in Greenland, right? Again, look, I'm not saying this that this is gonna happen, but they're talking about it, right? Trump's been on this deal for years now. And I was reading yesterday, well, what if we gave the Greenlanders a vote and said, there's 50,000 of you, the U.S. is going to give you all $1 million, okay? and then organize a vote, and then Greenland votes, 90% to become a U.S., proxy or whatever. That's $50 billion. Maybe that's not enough. We'll give them $10 million each. That's 500. The Greenland would go into the sovereign wealth fund. Okay. Trump signed an executive order. That's February the 2nd last year, wanting to set up a sovereign wealth. How are you going to fund that thing? This is where I remember Besson said, hey, they were going to stand this thing up and we're going to monetize the asset side of the balance sheet. Okay. So where do you get the cash for your sovereign wealth fund or to buy Greenland? You call in the Treasury, the notes from the Treasury that are it's 42.22. You remark the gold to $10,000 an ounce. You just mark it to the market price. You would get back, when you send that back to the Treasury then could send you over $1 trillion that they just create from thin air. It's an accounting gimmick. But you get $1 trillion that you wouldn't have to go sell bonds for. Well, what if you did it at $9,000, $10,000? You get two some odd trillion dollars. Okay, so this is how they would fund the sovereign wealth fund. This is how they could fund this crazy idea that was floated around yesterday that they're going to buy Greenland. And again, I'm not saying they're gonna, but that's how they would do it. They'd say that's deficit neutral. All we did was bring the gold that we already have on the balance sheet to some arcane price from 50, 60 years ago. We're just going to market at today's price. And by doing so, the Fed is going to hand the Treasury and we're going to put into our sovereign wealth fund $1 trillion. Okay. Anyway, they've said, watch the video from February the 2nd. They've said this is how they're going to do it. Monetize the asset side of the balance sheet. So anyway, I make a big deal of that in this year's macrocast. And it might sound crazy. Remember last year at this time, Doge and budget cuts and the dollar was soaring and gold was in a bubble because it was at $2,600 an ounce and it had to go back to its 200-day moving average in year 2000 and all this stuff. And it had already been up 27% in 2024. So when I said another 10% next year in 3,100, that was crazy talk. And when I said another 30% for silver up to the high 30s, oh, you're a lunatic. Don't you know what Doge is going to do and the dollar is soaring? You're a perma bull goofball. And then when silver and gold soar, I legitimately got an email, Elijah, in December telling me what an idiot I am because I only had 10 and 30%. I must just be a rube. How could I not have seen this year? So it's a no-win deal. So how do we get those numbers for this year? Gold, ever since it broke out to a new all-time high in early March of 2024, has moved up in a steady pattern of 20% rallies, followed by 2 to 4 month consolidations, and then another 20% rally. Okay. Back in the summertime, we were around 3,500. And I said, well, the next rally had 20%, take us to 4,200, 4,300. Where'd we go? Yeah, there, we even overshot it a little bit. We've been in consolidation since October. When we break out again, what's 20%? 5,000, 5,200. Say we consolidate again through the summer. What's another 20%? 6,000. So I'm just banking on that trend continuing, and I don't see why it wouldn't. Silver is following gold. It finally broke out to new all-time highs in October. Gold took 21 months to double from the time it broke out in March of 2024 to when it doubled fourth quarter of last year. So I don't expect silver. I expect silver to follow the same path. Why wouldn't it? But maybe it doesn't take the same amount of time. Maybe it takes half the time. And so that would give us $100 or so by summer. Heck, Michael Oliver referenced earlier, so it'll be $100 by the end of this quarter. So whatever. I don't know what happens after that, but I would imagine we'll probably keep chugging. And that's how I came up with that. You can see it's a real scientific process, Elijah. But again, it's a no-win deal, so why not?
The idea gaining traction in macro circles is that gold revaluation could quietly fund primary state objectives without issuing new debt. By marking gold held on the balance sheet closer to market value rather than legacy prices from decades ago, governments can unlock trillions in financial capacity through accounting alone. This approach reframes gold as a strategic asset rather than a passive reserve, enabling funding for sovereign wealth initiatives while remaining technically deficit neutral. At the same time, the price action supports the macro logic. Gold has followed a precise rhythm of powerful advances, followed by multi-month consolidations, repeatedly resetting before the next leg higher. Silver, having finally broken long-term resistance, is now tracking gold's earlier breakout behavior, suggesting accelerated upside as monetary metals reprice together. None of this relies solely on speculation. It reflects balance sheet mechanics, trend structure, and capital rotation away from debt-based assets towards sterner monetary anchors. Let's get back to the interview.
The more important thing that happened on October the 2nd is that was the first day that we went into, I guess it's fair to call it backwardation, of the spot price being higher than the futures price, which indicates a physical misallocation, a physical shortage, a physical stress, whatever. And it got really deep in October, and then it kind of evened back out. But even today, when the selling was heavy overnight, the backwardation got to 30 or 40 cents again, where the spot price was 30 or 40 cents higher than the front month March futures contract. And that is evidence, along with the lease rates in London and what we know about vault stocks and things like that. That's evidence that 4 straight years of supply deficit totaling 800 million ounces or whatever. That's evidence that the physical part of this fractional reserve pricing scheme is under stress. And then you've got China announcing back in October they were going to start having export controls. You've got the U.S. declaring silver a critical mineral. There's a lot of things that have made this time different, and I think it'll probably continue as we go into this year. So you'd have to change the physical supply-demand picture to have that pullback come about. If suddenly there's a global economic collapse and demand for industrial silver dies, suddenly there's global austerity, and the U.S. does not cut rates by half this year on the short end and institute yield curve control on the long end and does not run another $2 trillion plus in deficit spending. If all of that changes, that could impact not only the investment demand on the physical side, but also the demand for this safe harbor. What's the oh gosh, of course, this is my 60-year-old brain hitting me. What's the new trade? The debasement trade, right? All of that could get factored back out. Sure, of course. And we've got to be wary of that. But I don't think that's a likelihood. And I think this physical stress is what's underpinning the rise both for gold and silver. And the central bank demand in gold for the last 4 years has been well documented too. And I think that underpins the market and prevents really, really sharp pullbacks. And this notion, again, yeah, is it overbought, on technical factors and things like that? Well, I've never seen a monthly RSI this high and all that stuff. Okay, if silver is simply a dot on a screen and you can apply, Elliott wave and all this stuff to it, okay, yeah, sure. But I don't know, at this point, I don't think that dot on the screen is what's determining price. Even today, Elijah, we woke up this morning here in the U.S. On Thursday the 8th, and silver's down 5%. Well, why? Well, the price in Shanghai overnight was down 6%. And why was that? Well, they were raising margins in Shanghai. And so Shanghai was weak. And then once Shanghai closed, that allowed for extra selling in London. And by the time all of a sudden you're down 5%. It's not, anything else. So that's what was the main thing driving things this morning. So, and that's a physical market. So as long as that physical, demand, structural supply deficits and the like continue, it's going to be pretty. If you start selling futures to drive price back, and that drops price to 60 or 50, but the physical price, remains at 70 or something, that paper price ain't going to stay there very long. Is this volatility? That's why the CME does that. I mean, you're moving 10% in a day. The firms, want their clients to have more money in their accounts, right? So that the firm isn't stuck holding the bag, the broker dealer if something happens. And so we got a couple of margin hikes. What's nice is we've had continued volatility, not as much as last week, but we've had continued volatility this week. And we haven't gotten more margin hikes. So they must be at a level where they think is appropriate at this point. And that's fine. I, for one, would love a couple of days where we have like a less than 1% range in gold and a less than 2% range in silver. Gosh, that would be relaxing. I could just kind of chill out. And that's probably coming again. But for now, yeah, it's like one big green bar followed by one big red bar. And that can be exhausting. I think, if anything, where this has had a real impact is in the mining shares, because we have not seen a move in the mining shares commensurate with the move that we've seen in gold and silver, particularly over the fourth quarter. I mean, the GDX is only a couple points higher than it was in mid-October. I think a lot of that's due to just the amount of trading on a daily basis on the New York Stock Exchange that's done by high-frequency trading computers. I mean, I've seen studies that's 80, 90%. And so you might have, silver's gone up 50% or whatever over the last several months, but on an intraday basis, New York Stock Exchange opens at 9:30. And if in that first couple of hours, the price of COMEX silver is going down, these machines see that and they just sell. And you're constantly getting ratcheted back lower. And that's why the shares have been underperforming. And that volatility has played a major role in that. The U.S., China are taking kind of a war footing, The U.S., look what happened in Venezuela, all the other things that Trump is discussing, whether it's Colombia or Greenland or whatever. The stuff about critical minerals, the drill, baby, drill. I mean, the U.S. already is the number one producer of crude oil in the world. U.S. is kind of ring fencing itself against future adversarial events. And China kind of seems to be doing the same thing. And so this kind of how that impacts silver, copper, which is also at new all-time highs, $13,000 a ton in London. Gold as well, as a base of a monetary safety. All of these things, this is a trend that's not going to be reversed, I don't think. I'm not looking for, peace, love, and Bobby Sherman here to break out in 2026 and everybody just, we're all going to hold hands and dance around the Christmas tree next year. And so I think, this critical mineral stuff, the rare earth stuff, silver's just part of that. I mean, look at what Trump is trying to do with uranium. And then again, the rare earths, like, you just name what into the EMs, none of them come to mind right away, right? But they're all out there. And again, I think this is part of a strategy that I don't see reversed, and it is a positive for price because it makes metal more scarce. Okay. And you think, well, no, they're still mining this and that. But for the pricing scheme, and that, again, the pricing scheme in the West since January 1975 has relied on derivatives and fractional reserve and leverage of the actual physical metal, not the physical metal itself, the leverage of the physical metal itself. And what's being stretched now is that leverage, because the physical base is dwindling because of these, the lack of mine supply or the global central bank gold demand, whatever, that physical, and so the leverage is stretching. And so this cordoning off, walling off your resources, east versus west, only just exacerbates that problem. And so that's why in my forecast this year, I'm probably more bullish than I've ever been in terms of price, because these are trends that I think are almost certain to continue this year.
Physical stress, not chart patterns, is now driving the gold and silver markets. Backwardation returning in spot pricing, elevated lease rates, shrinking vault stocks, and years of cumulative supply deficits all point to a system where paper leverage is colliding with real-world scarcity. Add export controls, critical mineral designations, and ongoing central bank accumulation, and the foundation under these markets looks structurally stronger than in any prior cycle. Volatility may remain intense, but sharp, lasting pullbacks become harder to achieve when physical demand refuses to accept lower prices. Futures selling can temporarily push screens down, yet it cannot override shortages for long. This environment explains why price resilience persists despite technical extremes and why metals continue to reprice higher as strategic assets. If these trends hold, the underlying bull market remains intact. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.